I would like to welcome our next guest. He is He was a programmer who turned into a management consultant and who's currently a fund manager. His name is Anoop Vijaykumar. He has over 2 decades of experience under his belt and currently focusing on fund management and research, Capitalmind. He swears by his rules-based system when it comes to picking winners. And today he'll walk us through the less volatile route to creating wealth. Welcome, Manu, and over to you.
Thanks, Ankur. Thanks a lot. Appreciate you guys having me on here. Was listening into your presentation as well as Sonam's, and some pretty good insight about factor investing overall and low volatility specifically. So maybe I just add my perspective on how we think about low volatility. I'm just going to share my screen. Right. My screen's visible, right?
Yes, it is.
Yeah, cool. So I'm going to probably approach this from a more probably a practitioner's point of view, where what we have seen in the real world in terms of what's really panned out versus what we expected to pan out, and therefore what strengths and weaknesses that we see in factor investing overall, as well as low volatility in particular. So here's what I thought we could, I talk about. So first is to sort of take a step back and look at factors and say what really makes a factor. And there's a lot of really good definitions and explanations of what factors are. But if I were to sort of explain it to somebody who's not really steeped in investing and finance jargon, what would that explanation look like? And how do you separate, let's say, an ordinary or a bad factor from what might be an actually a factor that is liable to give you excess returns over the long term? And then sort of zoom into volatility in particular and say, well, how does volatility sort of fit into the mix of trying to find a superior investment style? Because if volatility is not really risk, it is just how much an investment moves around, then does it even matter in the scheme of things? And then to sort of go back to that basic question saying, well, does lower volatility mean higher returns? And to look at maybe just data from the US, from India, and see, well, what does that tell us? And then maybe get a little more specific about how we at Capitalmind have looked at low volatility and what role it plays in some of the portfolios that we manage. And to end with the limitations that we have seen that exist with volatility, and what anyone who's sort of considering it as an investment style should probably consider before taking the plunge. Just want to put the disclosure out there. We are a SEBI registered portfolio manager. We manage roughly about 700 crores currently in quantitative and fundamental equity strategies. So as a disclaimer, nothing that in this presentation constitutes as financial advice, simply because any decision on whether or not to invest in something should be taken based on your own assessment of your goals and your risk profile. So just making sure that is out there. So coming to what makes a factor. So we've talked about this is the factor investing conclave. So useful to kind of get on the same page about what a factor really is. And if I were to think about it in purely first principle terms, from my point of view, a factor is really a hypothesis about what might get you superior returns in the long term. And a factor is a quantifiable, codifiable parameter basis which you can objectively pick stocks or any kind of holdings for your portfolio that hopefully deliver excess return. Now, excess obviously could be subjective. For somebody, excess could be anything above inflation rate. For somebody else, it could be anything above risk-free rate. And the typical definition tends to be excess over what the index would have delivered anyway. So if you were to start with that kind of a broad definition of a factor, you could think about it in different ways. You could pick a portfolio of companies purely based on the largest free float market cap. If you were to pick the top 30, then you are essentially holding the Sensex. If you pick the top 50, you are essentially holding the Nifty 50. There's other ways to think about these, could be companies that are available cheap as per relative price earnings. So you could literally define price earnings as your factor and then rank companies in increasing order of price earnings and then hold the cheapest stocks. That would be your value factor portfolio. You could even extend this a little bit, maybe get a little bit outrageous where you could pick a portfolio of companies that are headquartered in Mumbai. Let's assume your hypothesis was that companies based in Mumbai tend to be, professionally run and they have access to a great talent pool. So maybe companies based there could outperform the rest. Or how about companies which have foreign educated promoters? They've gone to Harvard and Yale and come back with some great insight about how they want to run their companies, and maybe those companies tend to outperform the others. So these are all hypotheses or theories about what might help you outperform the index. Not necessarily all of them pan out, but this is one good way to start thinking about what a factor might be. Obviously, it's not that all of these are valid ways of picking portfolios or investing. So a couple of bad factor examples. So we spoke about how companies are headquartered in places. So the table on the left is really it's basically the Nifty companies returns of let's say an equal weighted portfolio of companies based on their the city that they're headquartered in. So if you were to think about the 50 Nifty companies, they've got headquarters across all of these cities. And if you were to build separate portfolios of companies which were based in each of those cities, here's how your returns would look like over the last 3, 2, and 1 years. So while the Nifty's done aggregate about 46% over the last 3 years, if you were to build a portfolio of companies based in Chennai, your return would be 280%. On the other hand, if you were to be invested in companies based in Kolkata, you'd actually be negative over a 3-year period. So, this is 3, 2, and 1 year returns, and it might actually look like, hey, is there something there? So that's one way of looking at it, and I'll come to why that's actually pretty ridiculous. On the right is an even more outrageous example of investing in companies which have, let's say, DA and I in their name. If you were to do that, then your returns would be, you essentially have grown your money 18x over 3 years compared to just about 46% for the Nifty. So again, two really bad ways of thinking about factors. The reason being, I call them Bangladesh butter production indicators. And that phrase comes from this paper that was published more than 2 decades ago by these two gentlemen, David Lineweber and Dave Creeder, who essentially looked at a whole bunch of macroeconomic variables and sort of looked at their relationship with the S&P 500. And the metric that proved to be the best predictor of the S&P 500 turned out to be the amount of butter that was produced in Bangladesh on a monthly basis. Clearly, they published this as a joke, meaning that there's no actual basis to ever link butter production with the S&P 500. But if you were to look at the statistical relationship, that it had an R squared of 0.99, which in layman's terms means that the two metrics really explained each other really well. But then you already intuitively know that makes no sense. So then how do you differentiate a bad factor from a good factor? Even before getting into something like a low volatility or a momentum or a quality. So there's 5 conditions that probably a good factor needs to satisfy to be taken seriously. So these are the 5. It has to be persistent, meaning that the impact of that factor, and if you're thinking of outperformance over the Nifty or the index as the criteria, then that effect needs to have lasted over a fair bit of time. It couldn't have been just a 1 year or a 2-year period basis which you draw your conclusions. It has to be pervasive, meaning that you ideally want to have seen that effect across markets, which is countries, regions, as well as asset classes. So you would like to have seen it across stocks and bonds and commodities and a few others to to really conclude that, yeah, this is pervasive across all investable assets out there. It needs to be robust, which means that it should be ideally be valid, not necessarily to the same degree, but at least similarly across different definitions of that factor. So if you were to think of value as a factor, you could implement it using price to earnings or price to book or price to free cash flow yield. And all these different definitions are just different ways of expressing the value factor. And you would expect to see that depending on, irrespective of how you define it, that kind of an approach would largely outperform the market. So if all of those definitions outperform the market, then you know that that's a robust factor. The fourth is it needs to be investable. So it's no good if a factor gives you a bunch of stocks, a bunch of microcap stocks which have absolutely no liquidity, which you can't even get into, or you can't even really invest any sizable amount into. Then it's not even really investable. So it needs to be investable. And lastly, and probably the most important, is intuitive. It needs to have some basis, we need to have a guess as to why a factor might work if it does. So if you were to analyze and find that all companies with blue colored headquarters tend to outperform, that's not intuitive, right? So that kind of fails that basic common sense test, which you would expect any factor to do. So if a factor tends to go through all of these five, then you know that there's probably something there. And which brings us to some of the factors that have passed through most, if not all of these criteria over time, which is value, momentum, quality, dividend yield, and also low volatility, based on analysis and white papers that have been done over time across markets, across asset classes. So this tells us that maybe, yeah, so if low volatility goes through all of these, then it probably has something there that is worth exploring. But then, does volatility even matter, right? I mean, volatility is just how much an asset moves around on a day-to-day basis. So does a relatively lower volatility asset become a better investment than a high volatility asset? I mean, some of the investment gurus have said that volatility is not risk, which is probably correct. And Seth Klarman has said that historic volatility doesn't tell you anything about the future. So given that, does it even make sense? So again, probably worth kind of looking at probably a real life example. So the chart here shows two investments. They've been indexed to 100 going back to 2014, investment one and investment two. If someone were to show this chart to you and ask you which is the better investment, it seems pretty clear, right? Investment one is, has gone up almost 7x, while investment two is a little over 3x. So there's a massive difference in the return that you've got over what is about 6 years, from 2014 to 2020. But then obviously there's a catch. And here's the completed chart going up to the end of March this year. And the orange lines come back almost to where the purple line is. So the two are almost roughly neck and neck over a period of 8 years. So now if you were to be asked the question, which is the better investment, you might have a slightly different perspective than you had basis the previous chart. So let's take a step back and say, well, if this is hindsight, then it doesn't really matter. So if you were to assume that the purple line and the yellow line are exactly at the same place, and you had made your first investment way back in September 2014, then it almost doesn't matter which one you had picked, because your returns are pretty much the same. So in that sense, volatility doesn't really matter. But then what about if you had scaled in your investment? If you had been doing an SIP into both of these investments, then your returns would probably look fairly different. In one, your SIPs starting Jan 2020 would have been in the red, while in the other, most of your SIPs would have been in the black, and you therefore wouldn't have lost money on any of your investments versus the other one. So that might look very different. Also, what if today you were to look at these two investments and you had to pick which one you're going to invest in? Now, Again, basis purely return performance, there's not that much of a difference. If anything, the orange investment seems to have potential for a lot of alpha at certain points in time. But my guess is, as most people would be very wary of picking the orange investment, which is the ARK Innovation ETF, and they rather stick to the other one, given the volatility that one has shown with respect to the other. Which means if intuitively we are drawn towards lower volatile investments when we are making our decisions, it then sort of follows that a lower volatility investment or a lower volatility strategy has the potential to outperform, given that people or we're just drawn to some of those types of investments, right? So that's the behavioral aspect of why a lower volatility investment might have a shot at outperforming the market in general. But that's sort of the behavioral aspect of it. In terms of the facts, we spoke about, persistence and pervasiveness. And so this chart is from a book titled High Returns from Low Risk. It is by a fund manager called Pim van Vliet, who he works for Robeco. And he published this comparing low volatility stocks versus high volatility stocks in the US, spanning roughly 80 years from 1929 to 2010. And the chart clearly shows that low volatility portfolios have done better than higher volatility stocks over that period of time. So that's clearly a sign that there could be something there worth exploring further, thinking about creating investment strategies. So coming to India, we've seen a similar chart in the earlier presentations, putting it here again, where the Nifty 100 low vol 30 compared with the Nifty 50 and the Nifty 100 even. Starting way back into 2005 to 2022, we see that the low vol index has done better than the benchmark or the broad market indices overall. So again, we've seen it. It's worked in the US, worked in India, which means there is definitely potential there for a low vol strategy. If you were to sort of shift the lens to more like a rolling return point of view, and rolling returns really about shifting the window, as opposed to picking one start and end date, which might favor one investment over another, depending on what's happened between those two dates. The rolling returns helps you look at how the performance kind of did over a period of time. So from 2005 to 22, if you were to think about 3-year rolling returns, which means starting from 2008, the blue line is what was the 3-year aggregate return of the low vol index compared with the Nifty or the Nifty 100. And even visually, you can see that the blue line largely stays above the other lines through the course of the time that we're looking at. In pure numbers, the low vol index outperformed the benchmark about 76% of the time. So if you were to look at when did it outperform, whichever one was better, Nifty 50 or 100 at any given point in time. So 76% of the time outperforming on a 3-year rolling return basis sounds pretty convincing, which means that low vol has largely done well. But then if you were to think about that, the right end of that chart, you can see that the blue line has been below the benchmark for some periods of time, which means in fact it currently is trailing the index on a 3-year rolling return basis. So which again sort of brings us to another interesting perspective, which we'll come to. So we've kind of examined low volatility from the perspective of, is it a factor that has been around for a while? Has it proved itself? Has it worked across markets? Has it worked over time? And it seems to have done that, and it, on a rolling return basis, it's outperformed the broad benchmark most of the time, if not always. So which means that there is something there which made us examine the factor to see what is it that we could do with it in terms of designing our portfolio. So we utilize it in two ways. One is as a single factor low vol portfolio, and the other is as an additional factor in our other quantitative portfolio, which is around momentum. And they work kind of differently in both those scenarios. So the single factor low vol portfolio is really about um, ranking the stock universe in ascending order of price volatility. This is standard deviation of daily returns, which has been annualized. We overlay those with some price trend filters, pick the top 20, weight them by their, basis their volatility, and then rebalance mostly quarterly. So we've added a few price trend filters over and above what the low vol indices have. The low vol indices tend to stick with purely using standard deviation of daily price movements and sort of keep it at that. We found that adding a few price trend filters tends to help with eliminating some stocks which might be in a secular downtrend while being fairly exhibiting low volatility. This is a fairly new portfolio that we just got started about 8 months or so ago. The backtests obviously show great things, but we know more than to just rely purely on the backtest to estimate performance. Early days yet, but we think there is potential for a largely a low volatility portfolio to outperform the benchmark if it has the right kind of conditions built in. We also believe there's other ways to improve on a low volatility strategy, which is to look at fundamental overlays, look at earnings growth, revenue growth, in addition to price trend, which could improve return characteristics. But obviously, that's something that you need to go back and validate and look at over long periods of time, look at individual year performance, see what kind of stocks get picked to be able to come to a conclusion that this can work in real life. So that's always an ongoing effort for us in terms of trying to see ways and means of improving factor portfolios and how is it that we can get them to offer better return characteristics. Interestingly, when we sort of go back into the past, the kind of stocks that a low volatility portfolio tends to pick has a significant overlap with what would be called a quality portfolio. So on screen, you see some logos there, which are some of the stocks which have appeared the most frequently over 15 years of running backtests of a low volatility portfolio. And, obviously very recognizable names here on screen. And they also tend to be part of, call it a quality portfolio or a coffee can portfolio or any of those. And it's just very interesting the extent of overlap between the two kinds, and we can hypothesize why that might be. And ours is that these tend to be low earning surprise companies. I mean, they tend to be consistent growers, but at the same time they're not going to surprise you with a 40% earnings growth in some quarter and a negative 20% in another. They largely tend to be within a certain range. Which tends to be in the single or the single basis point range of earnings growth, and because they are low earnings surprise, as I'm calling them, I guess the kind of investors who are going to be buying and selling are self-segmented into folks who are not necessarily looking for a short-term bump up in prices, and therefore people are not necessarily buying and selling these on a very short-term basis. Which might explain why some of these quality companies also tend to be lower volatility. And the keyword here is lower relative volatility, which means these stocks might be volatile at times, but that in the context of the market, that might still be lower than what most of the stocks are seeing at that point in time. So that was just useful to sort of get some perspective on the kind of stocks that get in, even though in factor portfolios, we're not necessarily looking at what the individual stocks are doing or what those individual stocks are. It's just useful to sort of peer under the hood to say, okay, what is it picking, and how realistic would it be that we would actually in real life buy those stocks and be able to hold them for the period that we're meant to hold them for. The second way we utilize low volatility is as like an add-on factor in our momentum portfolio, where we're looking at adjusting the relative returns of stocks. After ranking them for relative returns, we look at adjusting that for the volatility that those stocks have seen. So all things being equal, stocks with strong price momentum but lower volatility make the cut to be part of the portfolio. This is not the same as picking a low volatility set of stocks, because here the primary factor is price momentum, and on which we're layering on lower volatility to kind of eliminate some of the stocks which might be too volatile to be to be picks for the momentum portfolio. We found that it has reduced overall downside volatility for the portfolio, even in backtest as well as in live performance. We've seen that the kind of stocks that it tends to kind of filter out helps reduce the amount of downside that primarily a momentum strategy has. So what our hypothesis is that low volatility overall can be used standalone or in combination with other strategies, other factors to improve the return characteristics. So there is a fair bit of application for something like a low vol in just designing any kind of an investment approach. And we find that there's a lot more to sort of explore and learn about as to what something like this can offer. But there's a few limitations as well to something like a low volatility, and these are again from real world experience, what we've kind of come across and seen. So one is, the past is not necessarily telling you exactly what's going to happen in the future. So stocks do undergo regime changes. So if you were to think about HDFC Bank over the last year, it was a classic low volatility stock till recently, and then it has changed its behavior quite a bit. So that can happen, which obviously means that a set of stocks that you think are low volatility might just change their behavior due to a set of circumstances that specifically impact them. Low volatility underperforms at times. It especially over shorter time frames. If you were to look at performance since 2020, low vol strategies have underperformed the benchmark, have underperformed other factor strategies. In fact, over the last 9 months, low vol as a factor has underperformed the Nifty by a good 700 bips. And this is a time in which the markets have been volatile, which means you would sort of intuitively expect a low vol factor to have done better than the Nifty, but that's not been the case, surprisingly. Yeah. The Nifty is almost flat to marginally up, while low vol factor portfolios have been down by 5 to 6%, which is where that difference is coming, which is interesting because you don't expect that to happen, but then real life doesn't necessarily always reflect exactly what you expected. Another obviously drawback or consideration is no rousing company-specific narratives, and this is applicable to any factor-based approaches, where you don't have the luxury of building specific narratives around a company to build conviction, to be able to then hold it for X amount of time. You're going by a very specific quantitative parameter and then picking your stocks, which often doesn't work for a lot of people. So that's more a personality-driven thing where doing factor-based investing might not work for everyone. And my final point would be just basis its return characteristics in comparison with other factors and in the market overall. And this is based on looking at US stocks in India. If I had to sort of personify low volatility as a factor, I would almost call it like a rugged truck as opposed to a sleek Porsche, wherein it's never going to be this massively outperforming factor in most markets. It's likely not going to be the best performer, but also never going to be the worst performer. And that's and depending on how you approach it, it's a big strength or a weakness, where it is this portfolio that's not going to fall as much most times or nor go up as much, and therefore almost works like a shock absorber to your portfolio as a over the long term. So if somebody who has like a 15-20 year time horizon to invest in equities and can take on a reasonable amount of risk, I would almost think of low vol as as part of a core satellite approach in their overall portfolio, along with other factors, because this is going to reduce a little bit of a regret in times of markets correcting or being sideways. But at the same time, when markets are going through phases of strong up moves, a low wall will not necessarily go up as much, while something like a momentum or a quality or a value might do that. So use it in combination probably with other factors to build your overall portfolio exposure, and that to me might be the best use of a low wall kind of a strategy, provided that you have that kind of time horizon in mind. So that's pretty much it in terms of what I have to cover. Yeah, I think I'm going to hand it back to you, Sankar, if there's anything else we'd like to chat about.
Thanks, Anoop, for the varied perspective as well as how you do it at Capitalmind. I think one of the questions which we have been getting across the earlier two sessions as well, and for your session as well, has been on the recent underperformance of the low volatility strategy, right? So, of course, India, the history is perhaps not long enough, but if you have seen some similar behavior for the low volatility strategy across global markets or even in India in the past, where there has been a drastic underperformance, especially in a period of heightened market uncertainty, where the general expectation is that a low volatility strategy should do well.
Yeah. So that's interesting, because if you were to go back to 2020, when the COVID crash happened, and then after that initial uncertainty, the focus shifted to growth stocks and the work from home theme and all of that, you kind of expected low vol to underperform, because it was all about those growth stocks with the 40 and 50% earnings growth. And that sort of played out as you would have expected. Since late 2021, as the markets have become uncertain, again, logically or intuitively, you would think the low vol stocks would have kind of not fallen as much and have kind of would have held the line compared to some of those other growth stocks, but that's not really happened. And it's just one of those, I would call them anomalies, where the kind of stocks, and you mentioned earlier that it tends to be the CPG companies and the FMCGs that tend to be part of low vol strategies, and they have not really held. And if you were to maybe think about why, it could be because they're seeing a lot of price inflation to their inputs, and because that inflation has been so high, where they've struggled to pass those along to their end customers, which means that they're seeing margin contraction at the same time seeing problems with volume growth. So that probably explains why those specific set of companies which have been hit hard by inflation over the last 6-8 months, which tend to be part of low vol portfolios, have struggled, which might be why low vol as a factor has kind of underperformed.
Right. Also, and this is something which I keep thinking about quite often, but would like to hear your perspective as well. And at least I've read about it happening or seeming to happen in markets outside India, more developed markets, where there is a lot of crowding on the low volatility factor, where a lot of people are invested in the factor directly, maybe through an ETF or index fund, all of which follow the same approach. Because of which, one of the initial hypotheses for why the factor works is the whole lottery effect, overvaluing the lottery type stocks and undervaluing the low volatility stocks. Now, because you're investing sequentially into the low volatility stocks directly through this fund, maybe the undervaluation argument does not hold. So, do you think that if the strategy becomes popular enough, maybe once it starts trading 5,000-10,000 crores in assets, do you think that the downside protection that the strategy is typically associated with may go down a notch?
So obviously theory says that once everyone is aware and kind of buys into the underlying philosophy, then it should not exist, right? I mean, there's no free lunch. But if you were to think about markets going back, and this has been spoken of for pretty much any style of investing, right? So there was a time where you would have said that about value investing, because if everyone buys undervalued stocks, those stocks don't stay undervalued anymore. Similarly with momentum, similarly with quality. And I dare say that there are phases where any given factor gets a little crowded and then underperforms for a bit. and then there's enough people who lose faith and probably move on to shinier things, that factor then has a chance to make a comeback. And that's probably, so my argument really would be that everything mean reverts to an extent, be it low vol or momentum or quality. And at some point, there's going to be enough people who lost faith in, be it low vol or quality, which also has not really done very well over the last year or so, that there is space then for the folks who stay invested to then outperform. So I guess in a nutshell, mean reversion applies to pretty much anything, and it would to individual factors as well.
Right. So interesting you bring quality, and I noticed you also mentioned this in the presentation, that quality and low volatility seem to have a lot of overlap when it comes to their constituents, also when it comes to their market behavior. Is it fair to say that low volatility is a truer representation of a quality factor than the quality factor itself? The reason I say that is because the quality factor perhaps incentivizes companies to meet earnings targets, meet analyst expectations, not beat them. They don't want to risk underperformance also, so they want to. I don't want to use the word, inflate earnings or make artificial earnings, but try to work towards that with a very close mindset, as opposed to operating if they did not have those constraints. So, do you have any thoughts on those?
So my thought is low volatility is the signal that the two factors depend on. So quality depends on fundamental data, right? While low volatility relies on what is real-time price. One is available at a very high frequency. It's available pretty much every day for us to look at. Volumes are available for us to look at, while quality is something, or the underlying parameters that define quality get reported at specific intervals of time. So, I mean, if you were to assume that balance sheets get reported twice a year, that's twice when you are able to calculate whether it's ROC, ROE, price to earnings, or any fundamentally based parameter, which automatically means a significant lag in when you will get that information for every company in your data set. So if companies start reporting in April, probably the last company gets done reporting sometime in June or even later, July or August, right? So at what point do you then draw the line and say, I'm going to look at your current fundamental information to build my portfolio? Do you wait till the last company is reported, or do you, do it 1 month after companies start reporting? So to me, there is a certain, like you said, there is obviously an incentive to, I won't say game, but certainly massage those metrics to make them look good. But there is also the fact that that data can be stale, and the fact that because it is accounting information, you can obviously work a few things here and there to make present a picture that you would ideally want the market to see. So just from that point of view, price becomes, and this is a very personal perspective, is price and volume tend to be a more truer representation of what's happening with that stock, as opposed to relying on something that's reported sporadically through the year, and that too with a significant lag.
I know that you work a lot using trends. You've done trend following in a big way in the momentum fund that you're running. Do you think that the low volatility factor in itself also trends, or do you think that does not exist?
I'd love to be able to say that yes, because the holy grail would be to be able to tell which factor is it that's going to outperform, right, at any given point in time. So theoretically, figuring out the factor that's now starting to trend would be a great way to arrive at, okay, now it's value's turn, it's quality's turn, it's momentum's turn, and so on and so forth. At least so far, I can't say that we've found anything conclusive there to be able to anticipate or be able to say that X factor is now trending versus the other factor which is not, and therefore to be able to. But every factor does end up trending at some point, some or the other time. So like value has been out of favor now for 10 years, but then if you look at the last year and a half, it suddenly come out of the blue and sort of outperform quality and momentum or anything you were to think about. So there is something there, but just that it will probably take a lot more work to figure out if there is a dependable way of figuring out a factor that's trending.
Right. So this question is not only related to volatility; it's a more generic question, and it's a question which I keep getting asked. I don't know if you have also been asked this question, but quantitative investing is a catch-all term, right? And people associate quantitative investing with anything from HFT to factors to algo trading, uh, which also means that there is a lot of perceived risk with respect to which is perhaps overlaid across the different gamut of strategies that are out there. Do you want to make a statement as to the particular risk features of factor-based investing and where do they stand in the spectrum of risk as compared to maybe HFT, as compared to maybe algo trading? You may want to take other examples as well.
So, I mean, I would differentiate quantitative trading versus, let's say, an algo or an HFT, like you mentioned. Like algo and HFT really rely on literally speed of execution, right? I mean, they're reading signals and trying to get in and out before the rest of the market even has an idea that they've done it. While quantitative trading is obviously a much is a higher logical concept where you're trying to keep your biases, your judgment out of the way in deciding what goes into the portfolio. So you might like an ITC or an HUL, but if it doesn't meet the criteria to get into the portfolio, it doesn't. So in a way, you're trying to sort of remove or keep your biases aside. Not to say that quantitative is free of bias, because it reflects the bias of the person who's sort of coded the set of rules that picks the stocks. But by making it largely rules based, you're trying to keep it insulated from how you're feeling on that particular day. If it's overcast and it's a rainy day, and or you've had a fight with somebody or whatever, that ideally should not feed into your decisions in the portfolio. Whereas a purely discretionary approach relies to a large part on sort of assimilating a lot of information and then making your decisions, and then you might come across something very negative about a company that you own. What do you do at that point? If that's a large position in your portfolio, do you now ignore the bad news that has come, or do you try and justify it? Do you dig deeper to try and confirm, and then do you exit? So there's a lot more decisions to be taken by somebody who's making these decisions on a discretionary basis, which obviously has its someone who's really good at it, should probably do it, and they would outperform any quantitative approach simply because they're able to then add more nuance to the process. But for the bulk of folks, I would think it's harder to deal with that amount of information, and therefore codifying it, reducing it to a certain set of variables, and then only acting on those, whether it is to enter or to exit, probably means that you're going to you have a good shot at outperforming over the long run.
Right. And any specific risks that you want to mention with respect to the low volatility factor in particular, which maybe you've not covered, or maybe even if you want to reiterate is okay?
I think the risk to me is what it's done over the last year or so, right? I mean, it's just behaved differently from what you would expect in what has been a volatile environment. You would think that it would have been less volatile than the rest of the market, might have sort of retained, or if not gone up too much, at least stayed flat, which it has not done. And therefore, to me, the risk is that, in theory, there is no difference between theory and practice, but in practice there is, right? So, and we've seen that difference over the last year. So, and I would extend that to any factor-based investing, meaning that you've looked at data 15 years, 20 years, however long, and you've taken care to sort of make sure that your data is free of survivors or has no survivorship bias, is taking into account only realistic scenarios that you could have implemented, and yet the reality might turn out to be different. And that's what's happened with low vol in particular, right? And we can hypothesize as to why that might be, but this is probably what makes it interesting, where it's underperformed for a while. This is when a lot of people lose faith and move on, and that's when it might start to sort of come back and do its thing again. So that is the risk profile. It's gonna keep challenging your conviction at varying points in time, especially if there's a mad bull run. You're going to find again it's underperforming because you're holding all of these slightly more less sexier stocks potentially in your low vol portfolio. So what do you do then? So the fact that you're never going to be owning the stocks that are being spoken about at parties or in on forums and in discussions means that you're going to feel a little bit left out, and maybe the old fuddy-duddy who's owning stocks which no one cares about. And if you're able to deal with that and you're perfectly comfortable doing that, then yes, low volatility is a good strategy for you. But if not, then it's something to sort of really sort of question about whether it's the right thing.
Right. I think we've come towards the end of all the questions that we got for the session. So with that, let me thank you very much, Anoop, for this very, very good session. Your insights, sharing them very freely, as well as how you did it at Capitalmind.
Thanks so much, Shankar. It's been a pleasure listening to you as well as Sonam. Learned a fair bit. So thanks so much for having me on.
Thanks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.